Jason, you mentioned average selling price. That does seem to be one of the big key questions moving forward for investors is, can it continue to sustain that higher average selling price, especially with a new lineup of phones that is widely expected come this fall, and given the fact that you are looking at a higher price point? I mean, potentially a lot of folks are willing to spend $1,000 upward on an iPhone 10 because of the anniversary and the fact that it was so much newer. Will that continue?
Absolutely. I mean, if you just think about it on a per-day price, if people own these devices for 2 or 3 years on average, and they have a resale value of maybe 10, 20, 30% of the original cost, you're looking at $1 a day over 3 years. You're looking at 50 cents a day. Maybe people will even spend $2 a day. So I think the idea of a $1,000 selling price sounds crazy right now, but it sounded crazy for people to spend $500 or $600 on this device when they were spending $1,000 or $1,500 on a laptop. That seemed crazy 10 years ago. Consumers get massive value. And when you look at it compared to having a Starbucks every day, it's a de minimis cost. So they're providing massive value. They have massive margin. They have a massive amount of cash. They got to figure out a way, though, to keep the iOS ecosystem growing. They want to get to 2 billion or 3 billion people using these devices. And so taking the profits from the phone in the short term is going to throttle the services business, and Android is obviously running the table in terms of market share. So I wouldn't say this is all champagne and roses right now. I think that this is something to be very concerned about, the flat sales of the iPhone. That's their franchise. And so can the services revenue help? It's going to help, certainly. Is it a great business? Yes, it's a very diverse business. And one of the secrets of the services business that people don't know that well is subscription. So we've invested in a number of subscription businesses that are currently private, like com.com. And these businesses are now doing tens of millions of dollars a year. And Apple gets 30% of the first year, 15% of the second year. So you really can't begrudge them that if you're Spotify or you're Netflix or an emerging company like com.com or Fitbod. So that services revenue, and specifically the subscription portion of it, is going to grow significantly. I think it will accelerate in the next year. If you just anecdotally ask people at a dinner party who have iPhones, how many subscriptions do you have? Have you ever been to the subscription center in iTunes? You have probably 3 or 4. And I think it's going to wind up being 5 or 6. So that's going to be a money printing machine for them.
That's one area that I'm sure analysts are looking for more information, is the margin structure of services as opposed to phones, where there's a lot more suppliers you can check in with. I'm interested, Jason, because correct me if I'm wrong, in recent days you've written about how investors can protect themselves against a severe market correction. Not that you're trying to scare anyone or call for that necessarily.
Nope.
But explain that, and then explain how Apple might fit into something like that.
Sure. I think we have a number of black swans out there, things that we cannot know. And I think probably global instability and the tariffs, to me, seems like the most likely culprit if there was one. What I did was I wrote our 150 portfolio companies. These are private companies like Uber, Thumbtack, and then even down to smaller ones like com.com. And I just said, listen, if you can raise money now from great investors, I would do that, because if the market does correct and then turn into a crash, which we saw the correction last week, so I actually just had great timing on that, but nobody can time this. The question is, will these little corrections result in a contagion? You know, maybe that's always a 20 or 30% chance it could happen. So I just advised our companies, if you can take cash, put it into your bank account now at a good price or a great price from a good or a great investor, do it. Because in the down market, the great companies are built. So when we invested in Uber, or Thumbtack or Robinhood, it was a down market. And when you have cash in a down market, you can take market share. And that's the truth about startups specifically, is that the fortunes are built in the down market and they're collected in the up market.